Hello and welcome to Star USA Training. Today is Tuesday, June 13th, and we'll be talking about the export compliance with routed and non-routed transactions under the foreign trade regulations. We are recording this webinar. The slides and the recording and any other materials will be made available after the broadcast via email. One NCBFAA credit is available, and the code will be provided in that same email along with the recording and the materials. All participants are currently muted, but the Q&A feature is available. If you have questions, I strongly encourage you to ask questions. For those of you that submitted questions prior to today's event, those have been incorporated either in the slides or as questions later on in the webinar. And with that, we'll get moving in. Let me give you a little bit of an introduction to myself and Star USA Inc. Star USA is a trade and compliance consulting, advice, training, and services company. We provide in and outsourced trade operations for businesses of all types, including development and implementation of policies and procedures for trade compliance, audit and disclosure, administering any manner of trade-related aspect, including classification, origin determination, valuation, yada, yada. We also provide broker and forwarder management and oversight, as well as training in all areas of trade and compliance. My name is Mike Easton. I am the president and general manager of Star USA, and I am a licensed customs broker. I've been in the industry for nearly 20 years now. And I've worked with clients of pretty much every size and variety across just about every single industry. Live animals, I think, is an area I have not explored yet. But if you want more information on our education services or have questions about today's presentation, please feel free to email us at train@starusa.org or check out our website for more information. Without further ado, let's jump into the foreign trade regulations and the wonderful world that is exporting within the U.S. regulatory environment. During today's session, my aim is to present a baseline of information and provide a foundation for understanding. It's not meant to be an instructional session on how to file an EEI necessarily, nor am I providing any legal advice. I want to be very clear on that front. Effectively, I understand what the regulations are trying to do, but you all know your jobs way better than I do. And the regulations are only ever a framework or a guide to operate within. So if we run across anything that seems out of place or unclear to you, this is a good forum to surface that question, and we'll try and get it explored. So hopefully you'll have a good baseline to work forward from in applying these regulations to your environment. And in that effort, two simple rules that I like people to understand whenever considering export compliance and any regulatory environment. Exporting in the US is a privilege, not a right. It's not part of the Bill of Rights. It's not a constitutional guarantee. You have no foundational right to do business outside the borders of the country. And those privileges that you're given come with responsibilities, and those responsibilities have penalties attached. Additionally, those privileges can be revoked. If you're not following the regulations, you can lose your right to export. And secondly, within the export rules and regulations, you must be able to demonstrate your compliance. If you cannot demonstrate your compliance, then you are considered to be non-compliant. There is a presumption of non-compliance. Additionally, in order to be compliant, you have to know your role. If you don't know where you fit in the transaction, then you're not going to be clear on which regulations you need to be following and how far you need to take them. And there are different layers depending on what your role is in the transaction. I recommend implementing a comprehensive compliance program so that you have all of these things identified, understood, mapped out ahead of time, or at least as early in the process as possible. Even if you've been exporting for 30 years, knowing what the rules are and who's got which responsibilities and writing that down now is going to be better than waiting another year to do it, or 2 years or 5 years. You definitely want to be keeping and maintaining your records of your transactions and your dealings going back at least 5 years. Longer in certain circumstances, and we'll kind of touch on some of those later. But yes, those are the two fundamental rules. Export compliance in the scope of U.S. regulations is generally housed within the foreign trade regulations, which is Title 15 of the Code of Federal Regulations, CFR, Section 30. The foreign trade regulations govern pretty much the entirety of what the export compliance scope is. There are export controls, and that involves things like the Export Administration Regulations, the International Traffic in Arms Regulations, ITAR, EAR. There is the Export Control Reform Act that was recently passed. All of these are part of the exporting responsibility arena. But when we talk about export compliance, generally we're talking about the foreign trade regulations, the FTR. And throughout this presentation, I'll be making references to parts of the Code of Federal Regulations, particularly within Section 30. And these are some of the key citations here, but we'll see them on the slides as we go as well. Under the FTR, Exports are defined as the sending or transporting of goods out of a country. In the context of exporting, there are other considerations that could be considered exports, particularly services or information, but those are not considered under the scope of the foreign trade regulations. The foreign trade regulations is concerned with the physical goods, merchandise, supplies, raw materials, products, basically any item that is identified by the harmonized tariff system of the United States, Schedule A, Schedule B. That's what we're talking about within the context of FTR and export compliance and routed and non-routed exports. The EAR and the ITAR will consider non-physical goods, but the FTR is only focusing on physical. So not an export, we're talking about software, typically downloaded software, other than mass market or physical things that you would buy off of a shelf. If it's a physical that you can buy off of a shelf that you're exporting has a HS code, then it would count as a physical media. Services and information are also not part of the scope for the foreign trade regulations. Within the scope of the foreign trade regulations, we have a lot of acronyms. And two of the ones that you're going to have to add to your sphere of awareness are the EEI, which is the Electronic Export Information, and the AES, the Automated Export System. The EEI is the electronic export data as filed in the Automated Export System. That's the electronic record of the export that is transmitted to the Bureau of Census, which is part of the Department of Commerce, for statistical reporting and export control purposes. The EEI serves as the baseline for all export statistics. It helps inform things like international trade deficit, foreign policy, export control parameters, and lots of other key economic indicators that help the government function. Filing of the EEI is a legal requirement. It's codified under the FTR, and it has penalties for any violations of those regulations. The AES is the system where the EEI is filed, either by or on behalf of the party exporting the goods. The AES is accessed through another acronym, the Automated Commercial Environment, ACE or ACE. But effectively, in the regulations, they're going to refer to EEI and AES several times. And you need to understand that AES is a system that you're accessing. EEI is the thing that you're doing. You're filing the EEI. Those are the data elements. The foreign trade regulations, in addition to the tools that we use, the EEI and the AES environments, we have designated parties that have a specific role defined in the regulations. And under the FTR, there are 3 parties to an export transaction that are defined within the regulations. Basically, no other roles are defined or prescribed. They don't have responsibilities under the FTR, but these 3 do. And those 3 roles are the USPPI, which is the United States Principal Party in Interest. This is the person or legal entity in the US that receives the primary benefit, typically monetary, but it can be some other benefit from that export transaction. When you sell your goods, you as the seller are typically going to be the USPPI. Other countries use the term export of record, and in fact, the US used export of record back in the early 2000s and before, but that term was deprecated and replaced by USPPI, I think in 2001, 2002, somewhere in that time frame. And export of record has no terminology meaning under the foreign trade regulations. The US government does not recognize the term exporter of record. They use the term USPPI. Then generally, like I said, the USPPI is the seller or the manufacturer. Can be another party, but typically that's who it's going to be, the seller or the manufacturer. The FPPI, by contrast, is the foreign principal party in interest. This is the party abroad who purchases the goods for export or to whom final delivery or end use will be made. It may or may not be the ultimate consignee. In many cases, it will be. In a standard transaction, it's not uncommon to have the foreign principal party in interest to be the one receiving the goods and being the ultimate consignee. Unlike the USPPI and the authorized agent, the FPPI is not a named party on the EEI filing. They have responsibilities under the foreign trade regulations, but they are not explicitly shown on the EEI. Instead, the EEI requires you to name the ultimate consignee, which again may or may not be the FPPI. But generally speaking, the FPPI is going to be the buyer. They are located abroad. The authorized agent is the third individual or role that has responsibilities under the FTR that are specifically called out. The authorized agent is an individual or legal entity physically located in the US that has obtained a power of attorney or written authorization from one of the PPI to act on their behalf and to complete and file the EEI. To reframe that in a little bit less legalese, one of the principal parties in interest has nominated an agent to file the EEI. That agent has to be located in the US at the time of filing, and typically the agent is going to be the freight forwarder that's moving the goods. Not always, that seems to be the standard, the norm. The party who's authorizing the agent, whether it's the US principal party in interest or the foreign principal party in interest, is a critical aspect in deciding whether the transaction is going to be routed or non-routed. We'll get into the differences between routed and non-routed as we go, but recognizing that authorization of the agent is a critical aspect for determining routed or non-routed is essential to know up front. And again, generally the authorized agent is the export freight forwarder. Not always, but generally. So when is an EEI required? The general guidance, a simple answer is to follow the one rule. One rule states that all goods being sent from one US PPI to one foreign consignee in one country of destination on one conveyance on the same day is an EEI filing. If you have a scenario where any of these ones are twos, then you need to divide that into two EEI filings, one for each, so that all of the twos become ones. So if you have two US PPIs for one shipment, then you need to split your filings, even though you have one shipment going. That's kind of how the practice works. You would just work your way down that list of US PPI, foreign consignee, destination country, conveyance, and day, and make sure that all of them are ones. And then when do we need to file the EEI? Unlike the ISF, the importer security filing, you have to file EEI for all modes of transports. ISFs only need to be filed for vessel arrivals. But for export, for the EEI, you're filing for truck, rail, vessel, or air exports. And the rules are, for truck, it's 1 hour prior to arrival at the border. The truck has a 2-day journey to reach the border. Your deadline is still 1 hour prior to arrival at the border. For rail, it's 2 hours prior to arrival at the border. And it's customary for a lot of these things to be filed at the time that the goods are picked up or they begin their destination, but your deadline is 1 hour prior for truck, 2 hour prior for rail. For vessel, it's 24 hours prior to lading on the vessel, which is a very big difference from goods arriving at the port and goods departing from the port. That being laden on the vessel is a unique time point, and it's the basis by which they use that clock. So typically we advise to file when the goods begin their journey. For air, it's 2 hours prior to departure. So they can be on the airplane, they can be at the airport. As long as it's 2 hours prior to departure, that's when your deadline is. And again, you need to file for any mode of transport from the US, the 50 states, DC, Puerto Rico, FTZs located in US Virgin Islands. There was a petition to eliminate the need for filing between US Virgin Islands and Puerto Rico, US Virgin Islands, a couple other insular possessions. But the most recent advice coming out of the government is that they're going to continue with the standard practice of filing EEIs for shipments to Puerto Rico and other places like that. So even though it's still moving within the US, an EEI is required. The standards, the exemptions, and the exceptions. The standard here for EEI filing is that the EEI shall be filed through the AES by the appropriate party, typically the authorized agent, for all exports of physical goods. There are common exemptions from that filing standard. The two most common exemptions are shipments with the ultimate consignee in Canada, which is 15 CFR 30.36, and then commodities valued under $2,500 per Schedule B. So lower value shipments or exports per Schedule B, and then shipments going to Canada are the two most common exemptions to the EEI filing requirement. Tools of trade in their containers are also exempt, as well as shipments going from one point in Canada to another point in Canada, or from one point in Mexico to another point in Mexico that happen to transit through the US. An EEI is not required because the goods did not enter our commerce. Even with those exemptions, there are exceptions to those exemptions. And these types of shipments are not exempt under any circumstance, including low value. So any licensable shipments, whether it's licensed under the BIS, EAR, the DDTC, be it by ITAR, the DEA, Nuclear Regulatory Commission, yada, yada. If there's a license or an export permit required for the goods, then an EEI must be filed, regardless of value, regardless of destination. The EEI is required. If the goods are subject to ITAR, but exempt from a license requirement, if it has an ITAR designation from the US munitions list, USML, then you must file the EEI, even if it's below value, even if it's going to Canada, even if a license is not required, but it is part of the International Traffic in Arms regulations, then you would have to file an EEI. Additionally, all rough diamonds are required and self-propelled vehicles are required. Any self-propelled vehicle. So the key takeaways from the regulatory baseline and the universe that we're working with, There are three primary parties that you need to be aware of under the foreign trade regulations: the USPPI, the FPPI, and the authorized agent. Each one of them has a set of responsibilities. We'll go into those responsibilities here in a moment. Additionally, the EEI is required whenever the goods are more than $2,500 per Schedule B classification. If you don't know what that is, that's kind of outside the scope of this conversation, but you can email us and we'll give you some guidance. EEI is required when the goods leave the country by any mode. Again, any way that the physical goods leave the country, an EEI is required. When the one rule is met, so all those ones have to be met, and then no exemptions apply. So you must have an EEI on file for all of those cases. A couple of questions coming into this that we prepared were submitted to us. A common question that we see on Schedule B: if I have many different items in my shipment and none are over $2,500 per Schedule B, but the total shipment is over $2,500, is an EEI required? And the simple answer is no. If each Schedule B totals up to less than $2,500, and you've got several of those items, all of which combined, despite being different Schedule Bs, combined equal more than $2,500, you still are not required to file the EEI. The exemption is on a per Schedule B basis, and if none of the goods require a Schedule B or cross that Schedule B threshold, then no EEI is required. Special merchandise, we get a common question of what is considered a self-propelled vehicle. In fact, we've had to deal with the agents at the various ports, particularly going into Canada, on registration and reporting of VIN information and things like that for relatively obscure things that people don't normally consider to be vehicles. Things like forklifts that have wheels and motor, even if they're propane propelled. Types of pallet jacks that are self-propelled. Basically, if the item is powered under its own internal combustion or other sort of movement, even electrical, then it likely has to be declared on an EEI, even if it's going to Canada. Golf carts count in here, basically anything with a motor and wheels. Hopefully those are clear, and we're going to move now into routed versus non-routed transactions. If you guys have more questions, feel free to put them in the chat. I will have little breaks in here to unpack those. And for the one question that we have, yes, a copy of the materials will be made available to all attendees after following the session. There will be an email that goes out to all registered people. When we're talking about routed versus non-routed transactions, it's important to understand, using the context that we just talked about, the definitions, the roles and responsibilities that we have, and then to look at what the requirements are by the definition of routed or non-routed within the regulations. Under the foreign trade regulations, the FTR, the definition of a routed transaction is provided as under 15 CFR 30.3E, in which a transaction in which the FPPI has authorized a U.S. agent to facilitate the export of items and to prepare and file the EEI. The definition is, again, the FPPI has authorized the agent who will then prepare and file the EEI. That's a very unusual definition. Most people don't consider those parameters when thinking about whether a transaction is routed or not. They look at other factors on how much control they had over the movement of cargo and that sort of thing, but there's other parameters in here. Contrast that against the definition of a non-routed, which is not provided for in the regulations. In fact, there is no definition of a standard transaction. There is no definition of a non-routed transaction. They only provide a definition for a routed transaction, and therefore anything that does not meet the definition of routed must be non-routed and must be a standard transaction. Let me say that again. Any type of transaction that does not meet the definition of a routed transaction in the foreign trade regulations is therefore assumed to be non-routed or standard. And all the responsibilities of a non-routed or standard transaction are going to be assigned accordingly. Baseline, in a routed transaction, the USPPI is responsible for fewer data elements, but they include standard things like address and tax ID and product-specific details. The FPPI in a routed transaction is assuming the responsibility for filing, and typically routed transactions most closely align with FCA and Ex-Works Incoterms rules. The U.S. government does not acknowledge Incoterms rules. Those are an artifice of the International Chamber of Commerce. They are a sales tool. They are not part of the regulations, and our government does not care about what Incoterm you use for your transaction. They care about whether or not your transaction meets the definitions of routed transaction. But for shorthand's sake, generally speaking, FCA and Ex-Works are the most common routed transaction type Incoterms. So a route transaction, again, is a transaction in which the FPPI authorizes the U.S. agent to facilitate export of items and prepare and file the EEI. In a routed transaction, the USPPI's responsibilities include either performing as the agent themselves or providing the FPPI's agent with data elements defined in 30.3E 1 through 12. So there's 12 data elements that are required for the USPPI to provide to the agent. And the USPPI must keep their own records in connection with the transaction. In a routed transaction, the FPPI's responsibility under the foreign trade regulations is to authorize the agent. And the authorized agent's responsibilities are to receive and retain the authorization, to file the EEI, to provide evidence of filing to the USPPI, particularly upon request, as well as to keep their records of the filing itself. One of the questions that we had regarding this, in a routed transaction, what is the USPPI's documentation responsibility when the forwarder identifies an overage or shortage, or when the customer decides to split a shipment? Is the USPPI responsible for providing amended documents in either situation? Generally speaking, the USPPI's responsibility in a routed transaction is to provide the information defined in 30.3E, those 12 data elements, to the forwarder. Anything outside the scope of those 12 data elements is generally not the USPPI's responsibility. Where quantities come into play, then USPPI would have to provide that, but I don't believe that's one of the data elements there. So let's contrast that against the responsibilities for a non-routed transaction or a standard transaction. Again, these are not explicitly defined in the regulations. This includes any transaction that therefore does not meet the definition of routed. In a standard transaction, in a non-routed transaction, a USPPI is responsible for authorizing the agent or else self-filing, providing that agent with accurate and timely information, adhering to all filing requirements defined in 30.6, and record-keeping responsibilities. The FPPI in a non-routed transaction has no explicit responsibilities. Their responsibility is transactional in nature, has nothing to do with the regulations. The authorized agent has the same responsibilities: receive and retain the authorization, this time from the USPPI instead of the FPPI, file the EEI, provide evidence of filing to the USPPI, and maintain their records. So not a huge dramatic shift in what the responsibilities are, but the key one being that the FPPI is not authorizing the agent and therefore has no responsibilities. Authorized agents are authorized by the USPPI in non-routed transactions or by the FPPI in a routed transaction. The agent must be physically located in the US at the time of filing. We have seen questions from partners overseas, USPPIs that have a US operation that are exporting or resale by a sister company or a subsidiary or related business, and they want their subsidiary overseas to file the EEI as a self-filer. They're not allowed. If they're not physically in the US at the time, they cannot file an EEI. Even foreign forwarders who do not have an office in the US that are manned by US employees, they'll need to sub out to another forwarder to handle the EEI filing. Not all forwarders can perform all roles of authorized agents equally. So being aware of where these people are located is actually part of their obligation and part of the obligation of authorized agents generally. Agents are also required to obtain a power of attorney, or more commonly, a written authorization from one of the PPIs based on the type of transaction that it is, to file that information, to file the EEI on their behalf. The written authorization should specify the responsibilities with particularity. This is guidance from Census. They advise that you specify to what extent the agent is representing you. If it's for one specific transaction, then only give them an authorization for that one transaction. Again, the authorizer is either the USPPI or the FPPI. USPPI if it's a non-routed or standard transaction, FPPI if it's a routed transaction. Only one party authorizes the agent, and when they do authorize the agent, it should be specified to a certain degree or type of shipment or time period or some other factors to limit the amount of representation that the forwarder has for your business. And again, routed transactions, USPPIs would not provide the agent with the power of attorney or written authorization. Data elements under the regulations are grouped into three categories. And these are all spelled out in 30.6. There are the mandatory data elements. So this is in all cases: who's sending it, what's your name, address, what's your EIN, who and where is it going, ultimate consignee, type of goods, destination, how and when is it going to leave, what's the carrier and conveyance, what's the port of export, what's the time of export, is it a routed or non-routed transaction, and what is the cargo? What's the HS number? What's the description? Is it domestic or foreign? Quantity, value, hazardous, yada, yada. Conditional data elements are as the case may be. If it applies, then it must appear. If it does not apply, then it does not need to appear in the EEI filing. If there are other parties, like other agents or intermediate consignees other than those that are party to the transaction explicitly, there's export control information, either an ECCN number or a license information or an ITAR designation or some other regulatory commission or other agency that has issued a license or has some sort of control over the goods, then you must declare it in that case. And if it's a special export, then you must provide information regarding the foreign trade zone, diamonds, certifications, the special vehicles, and things like that. And then lastly, there are optional data elements. And this is just as the principal parties in interest may require or request. You can include seal numbers or equipment numbers on the transaction. They're not required, but they do help with shipment integrity and maintaining a secure supply chain. So in a lot of cases, those are recommended, but again, not required. So the data elements that we were talking about are defined in 15 CFR 30.3E. Routed transactions, these are the 12 data elements here. This includes your name and address, your EIN number, the state of origin where the goods begin their journey for export, the foreign trade zone information if applicable, a description of the commodities, a D or F indicator, which is for domestic or foreign, DF, Schedule B or HTSUS classification, the quantity and unit of measure, the value, the ECCN, the licensing information, and the information known to affect licensing. So 10 through 12 have to do with export controls, ECCN, licensing information, information known to affect licensing. Those are all relevant information pieces that need to be provided to the agent so they can file the EEI correctly. And looking at quantity and unit of measure, those are not necessarily related to what's actually being exported out of the country. Those are related to what's being provided for export. The forwarder may elect to split the shipment, or the customer, the FPPI, may elect to split the shipment into different components, different directions, different places. You'll notice that on the routed transaction, it does not include destination information or ultimate consignee information. Those are up to the agent to advise for the EEI filing purposes based on information from the FPPI. The forwarder is going to know where the goods are going, and they're going to be responsible for providing that information, including how much of what quantity is being shipped to which destination. The USPPI is responsible for providing information on what quantity was provided to be shipped. A little bit different. Non-routed transaction, a standard transaction, the USPPI has responsibility for all 48 of these data elements. The ones in blue correspond to the same as the routed transaction, just to kind of draw a reference there. You don't need to memorize these. Effectively, the USPPI is responsible for all of the information that gets filed in conjunction with your agent, and the FPPI has none of the responsibilities. Whereas in a routed transaction, the USPPI has 12 data elements that they are directly responsible for, and the rest are for the agent and the FPPI. Hopefully that's clear. I'm going to tackle some questions really quick. Would an item such as goggles valuing over $2,500 be considered a tool of trade and therefore not need an EEI filed? Technician's goggles is what the item is described as, and my guess is that this is for a service thing and the goods are going to be coming back into the US and they're only temporarily being exported. Yes, they still count. They are not a tool of trade. A tool of trade are things of instruments of international traffic, things like pallets, certain containers or reusable containers, certain categories of goods are defined in the regulations as tools of trade and international traffic, IIT, instruments of international traffic. So definitely look at the regulations to see what counts there. Most things are not going to, unless they're a standard part of packaging goods and getting them moved. Here's another question. We send an FCA shipment to a freight forwarder who handles the shipment on the client's behalf. We have written authorization from the consignee to file the EEI. Is this routed? We are the USPPI, but we are also an authorized agent. The USPPI can also be the authorized agent in a routed transaction. So yes, the scenario that you're describing is that your company is fulfilling the role of both the USPPI and authorized agent. So you would get both sets of responsibilities in a routed transaction. Effectively, your scope of data elements, the information that you need to provide and have access to, is going to be effectively the same as what's in a non-routed transaction, but what you file, like on the routed or non-routed flag indicator on the EEI filing itself, you would indicate that it's a routed transaction. That's one of the key differences. And you would have to work with more partners to make sure you're getting the right information. Follow up, we send FCA to a freight forwarder who files the EEI and is authorized by the FPPI to do so, routed or non-routed. If it's an FCA shipment going to a freight forwarder who files the EEI and the freight forwarder is authorized by the FPPI, that's a typical routed transaction. That's the definition, the textbook definition of a routed transaction. So that would be routed. How are intermediate consignees defined in the regulations? Must they take physical control? My understanding is yes, they must have a direct ability to influence the movement of the cargo, which is typically viewed as taking possession of the goods, not necessarily. Intermediate consignee is defined in the regulations. I don't have it right in front of me to give you the textbook definition, but they do have a specific definition. It's going to be defined under 15 CFR 30.1 probably. So I would look there first. EAR classifications do not need to be reported. If the goods are designated EAR 99, that means that they are not subject to the Commerce Control List, the CCL, and don't have an ECCN number except EAR 99. And therefore, you are not required to get a license. Obviously, there's no country chart aligned with an EAR 99 designation. If you elect to fill in EAR 99 in the ECCN box, you're allowed to. It's not going to prevent you from doing that, but you're not obligated to. And if you have an EAR 99 set of goods and it's below $2,500 or is otherwise exempt, it's going to Canada, whatever it is, you are not obligated to file EEI for those goods. EAR 99 is considered not subject to the Commerce Control List. Question on why would FCA be considered routed? In FCA shipments, typically FCA standing for free carrier Incoterms. And again, this is not the actual rule. There is no alignment in the rules. In an FCA shipment, the U.S. seller is typically responsible for getting the goods to the first port of departure. Sometimes it's just getting the goods loaded on the first conveyance that's picking up at their warehouse. But typically it's to get the goods to the forwarder's warehouse or the first point of departure. And from there, the forwarder, typically nominated by the foreign buyer in an FCA transaction, one of the rules of FCA is that the buyer is responsible for the export, transportation, risk responsibilities, all those things. That forwarder works for the FPPI, works for the buyer. And therefore, that's most closely aligned with what is happening in a routed transaction. The FPPI has selected the forwarder. Presumably, they have also authorized that forwarder to be the agent, and therefore that would make it a routed transaction. But the forwarder is working on behalf of the FPPI. Is there any restriction on filing EEI when it is below the filing threshold limits? There are exemptions to the exemptions, or exceptions to the exemptions, however you want to frame it. If your goods are below $2,500 or are going to Canada, you do not have to file the EEI unless it is subject to any license, if it's an ITAR good, if it's a self-propelled vehicle or diamond, or one of the other exemptions that was named before. So hopefully that brings us up to speed, and we're going to take a look at some scenarios. Get some practice. I think I kind of tackled some of them in those questions there as well. But here we're going to go through standard or non-routed transactions. Which ones are standard? Which ones are non-routed is the question on the table. In scenario one, you are a U.S. manufacturer. A company in Singapore wants to buy your product. You agree to deliver the product to their door and call your freight forwarder to make arrangements. The question is, are these standard or non-routed transaction? Foreign company wants to buy your product. You agree to deliver the product to their door, and you call your freight forwarder to make the arrangements. That's going to meet the definition of a non-routed. The foreign principal party interest is not selecting the forwarder, and they have not authorized the forwarder here. You're calling your own forwarder to make it happen. Scenario two, you are a U.S. manufacturer. The company in Singapore wants to buy your product, so same as scenario one, and you agree to work with their freight forwarder to deliver the product to their door. You're interfacing with the forwarder and you're helping make arrangements and schedule time and all that stuff, but it's not your freight forwarder, not working for you. That's typically going to align with a routed transaction because you have not nominated the freight forwarder for the transport part. Presumably, you're not also authorizing that forwarder because they're not working for you. They're coming to pick up the goods from your facility, but that's the extent of your involvement with the actual movement of the cargo out of the country. And you would want to make sure that those are aligned with routed by making sure that the authorization from the FPPI is being given to the forwarder. All right, last scenario, you're a U.S. distributor, you haven't manufactured anything, you just have goods. Company in Mexico wants to buy your product. You agree to deliver the product to the buyer's freight forwarder in Laredo, Texas. Is this routed or non-routed? In this scenario, you have some transportation responsibility. You're getting the goods to Laredo, but you're not actually responsible for the transport into country. You're not responsible for the actual exportation. You're going to be giving it to their freight forwarder, the buyer's freight forwarder, having a handoff. Your shipping company, your trucker It's going to bring them down to Laredo, drop them off at the forwarder's warehouse, and that forwarder is going to affect the crossing into Mexico. And that forwarder that you're dropping them off at works for the buyer. Therefore, this is going to most closely align with a routed transaction. This is not a standard. This is not a non-routed transaction. Shipper's letter of instructions. This is one where we see a lot of questions, a lot of uncertainty on what to do when the forwarder has asked you to complete an SLI. If you're a U.S. exporter, U.S. manufacturer, U.S. distributor, forwarder reaches out to you and say, hey, fill out this paperwork, whether they're working for you or for the FPPI. What is the SLI? SLI stands for Shipper's Letter of Instruction, and it provides information to the agent that allows them to prepare and complete the EEI. Typical SLIs contain the key data elements from 15 CFR that we referenced earlier, those 48 data elements. It's going to reference those in some way or some capacity. The reason they're asking for this is because most companies do not provide all the necessary data on their standard commercial documents. Most of those data elements are just not relevant to a commercial document, your commercial invoice, your packing list, or even your bill of lading. A lot of those data elements just don't appear there. And the forwarders have created their own form to ensure that the complete info. This form, this SLI, is based on the SED form, the Shipper's Export Declaration form that used to be in effect from Commerce back in the late 90s, up until the late 90s, basically. Once the SED went away, Shipper's Export Declaration form went away, forwarders adopted the Shipper's Letter of Instruction form. Therefore, the SLI is not a regulatory form. It has no regulatory imperative. You are not required to complete an SLI. You are required as a USPPI to provide data elements to the agent in connection with whether it's a routed or non-routed transaction, but you are not required to complete their form. Forwarder may refuse to do business with you because you're not doing their form, whatever. All those things can come into play, but there's no regulatory obligation. However, the SLI does contain information of a regulatory nature necessary for the filing, and you're responsible for whatever you put on the SLI. Even though the SLI is not regulatory required, the information you put on it is used for regulatory purposes and therefore must be accurate and complete and all of those things. And lastly, with SLIs, you want to be careful of language like, I hereby authorize this forwarder to act as my agent and to prepare and file the electronic export information, yada, yada, yada. If you check that box or if you sign a piece that has that language on there, what you're indicating is that you are authorizing the forwarder, and therefore this is not a routed transaction because one of the requirements of the routed transaction is that the FPPI has authorized the forwarder. If you provide the authorization, you are taking this out of routed and putting all of the responsibility of a non-routed transaction on your own shoulders. And as long as you're in compliance, it's not a big deal, but you need to know what you're doing. So the key takeaways from this section, knowing who authorized the agent. The party authorizing the agent could be the most critical factor in determining whether the agent or whether the transaction is considered routed or not. If you cannot definitively state who authorized the agent, you need to clarify that so that you can be clear on which set of regulations, which roles and responsibilities you are required to comply with and to what degree you need to be in compliance. Oh, and you want to match your actions to fit your intention. The regs don't care about your intentions or who you thought was responsible. That's what the Incoterms are for. Incoterms are for clarifying your intentions and who you think is responsible. In the regulations, the documentation is what matters, and you have to be explicit. If you have provided the authorization, it doesn't matter if your intention was to have a routed transaction or not. You have a non-routed transaction because you provided that authorization, and the FPPI did not. So you have to be very clear, and your paper has to match regulations, not your intentions. A couple of questions here before we get to the last section. We're getting a little bit short on time, so hopefully we'll be able to cross all the hurdles we need to. In routed transactions, what is the USPPI's documentation responsibility when the forwarder identifies an overage shorter? Oh, I already tackled this one. You are responsible for providing the quantity as you provided it to the forwarder, but the actual filing is going to be determined by the agent. They're responsible for finding the correct information of what actually got shipped based on the one rule. Records. In routed transactions, what kind of documentation would serve as evidence to the shipper that the correct EEI filings have been completed for export compliance purposes? So what kind of docs serve as evidence? So the data elements are defined in 30.3E1. The documentation that you're typically looking for are commercial invoice, packing list, bill of lading, in addition to shipper's letter of instruction or similar documentation like that defines those elements in particular. But you're, again, not required to provide an SLI. You're only required to provide the data elements and, for other reasons, the commercial invoice packing list. What are recommended procedures for handling parties that filed against the company's filing number without their permission? All right, we're going to get into that question here in the next section when we get to the auditing. Is the SLI required to be signed by the USPPI in a routed transaction? Because the SLI has no regulatory basis, the SLI is not required to be signed in any capacity. If you provide information to the forwarder on an SLI, you are still responsible for the accuracy, regardless of whether it's signed or not. That's why you need to keep records of what you provided to the forwarder so that they can verify that what you provided and what you filed or what was filed by the forwarder are in congruence. If they're not in congruence, and you have your records and they have their records and they don't agree, then something weird's going on. Signature is not a requirement from the regulatory side. If you're giving an authorization, a written authorization or a power of attorney, you must sign that. And if the SLI is the version of the authorization that you're choosing to use, then yes, you would sign that piece of that. You are responsible for the accuracy of the information you provide, regardless of whether or not it's signed. Maintaining compliance, penalty risk, compliance practices, and references. I'm going to talk even faster here. I strongly recommend anybody watching this to watch it back on YouTube and slow it down. And it works out great with my talking speed. And I apologize for anybody that's having trouble following along. There are penalties for non-compliance. I want you to avoid penalty risk by ensuring that the EEI is getting filed, that it's getting filed on time, and is getting filed accurately. And lastly, keep your records for at least 5 years from the date of export, not the date of shipment, the date of export. And longer in particular circumstances, things like drawback or licensable shipments or re-exports, things like that. The penalty universe that we're talking about for failure to file is $10,000 per instance, plus potential forfeiture. For late filings, $1,100 per day, not to exceed $10,000, plus potential forfeiture. And filing of false or misleading information is $10,000 per violation, and again, forfeiture. These amounts vary based on inflation, things over time, but generally speaking, this is the universe you're looking at for civil penalties. These are making errors in the course of. If you do have a violation of the penalties, you can mitigate the costs down, particularly if it's a civil case, not a criminal case. And I think the first offense fee is something that $200. It's published in the regulations. I think it's $200 for the first offense, $500 for the second, $1,000 for the third, and then it goes to the standard penalty amounts listed in the regulations. Criminal penalties for failure to file is $10,000 plus up to 5 years in prison or both per violation. Again, for criminal violations of failure to file. Filing false or misleading information on a criminal case, $10,000 plus up to 5 years in prison or both. In furtherance of any illegal activity, $10,000 plus up to 5 years in prison or both per violation. Forfeiture, again, is forfeiting your interest or your interest in the merchandise itself, so they can seize your merchandise. All right, so what you want to do is establish and maintain export compliance in order to avoid these penalties. The first thing to have in place are policies and procedures. Make sure that you're adhering to the guidance given to you by other export agencies like the Bureau of Industry and Security. I'll give you a link to their resources after this. Make sure that you have good communication between your internal stakeholders, including your sales and shipping teams, your compliance teams, your management teams, as well as your customers, your forwarders, your brokers, your distributors. Make sure that you all know what the rules are and that how your transaction is being set up is in congruence with what those rules are. And then lastly, create an audit program to leverage your ACE reports, document your accountability chain and your processes, and review your records regularly. And one of the questions submitted before this is, what does an audit program contain? These are some of just high-level bullet points. For standard non-routed transactions, you want to be ensuring that you have timely and accurate filings. That means you want to make sure that you're paying attention to the rolled bookings to see if the filing is made on time. Whenever cargo doesn't move as scheduled, there is a higher propensity for there to be errors on the timely side. And again, it's $1,100 per day for late filing up to $10,000. And are you providing information between yourself and your agent to ensure that they have the information in a timely manner? Knowing what the actual deadlines are for the regulations is one thing. Knowing what your agent needs in order to adhere to those deadlines can be a completely separate matter. 24 hours before vessel lading, and again, with rolled bookings and cargo being picked up at various times or departing from warehouses on a weird schedule or being consolidated, it can get pretty messy. So knowing if you are exchanging information appropriately between all the players is crucial to having timely filings. Accurate filings, you want to make sure you're paying attention to the critical data elements. Those include, the things enumerated on the EEI filing data elements, but also some of the riskier things, like things that are problematic if you get them wrong for the government's purposes. If you don't have the correct ultimate consignee, if you don't have the correct HS code or value or ECCN determination, things like that. There are riskier portions of the data elements. Some are riskier than others. As well as making sure that you're paying attention to the modified transactions. Again, If there's a roll booking and the original date of export on the EEI was, June the 13th, but the goods didn't actually depart until June the 18th, that has to be updated. So knowing that the actual time of export got updated is part of the equation. Filer verification, having an approved list of agents and forwarders. And this goes towards the question that was asked in the chat here, where the question is, what are recommended procedures for handling parties that filed against the company's filing number without their permission? Or if the filing was completed incorrectly, marked as routed rather than routed, marked as non-routed rather than routed. If you're reviewing your ACE reports, you can view both your routed transactions as well as your non-routed transaction. There's limited information in the routed reports that you can get out of ACE, which is by nature, that's what's supposed to happen. But in the non-routed transaction, you can get access to all the information. And one of the pieces you get out of that is who filed it. If you identify a forwarder or an agent on either of those reports that you think should not be there, you can take a couple of different courses of action, notifying that forwarder that they potentially did this in error and asking them to correct it because they are responsible for having accurate information filed and they were the filer. And if they filed something inaccurately, including routed or non-routed flag, including filing under the incorrect USPPI's EIN or other factors, they have a responsibility for correcting it. If they fail to correct it or are unwilling to correct it, you can report them to Department of Commerce, Bureau of Census. There's a hotline that I don't have available here, but the Bureau of Census website will give you a vector for reporting errors like that. And effectively, your responsibility as a USPPI is to ensure that you lived up to the obligations and that you have your documents and your records in order so that you can rebut any incorrect filings that either you discover or are discovered by Census or another agency or by PPI or forwarder. There's an obligation to have correct information filed. If you're not responsible for the filing, either as the agent themselves or as the USPPI contracting with the agent, then the best you can do is notify the people that made the error and make sure that your records are in order. But lastly, here on the standard non-routed side, you want to make sure that your communication streams are open and functioning correctly. Most breakdowns happen because of communication breakdowns. Most errors happen because of communication breakdowns. If you don't have good communication between all the right parties, then you're going to have a bad time. On the routed transaction side, you want to have good communication with the agent. Make sure that your FPPI has notified you who the agent is, what the contact points are, so that you can provide them information directly. You don't want to have a scenario where you're providing information to your customer and relying on them to provide the correct information to the forwarder. You want to know exactly what it is that you provided to the agent and have a record of your communication with that agent. We have seen instances where foreign buyers will alter documentation before it goes to the agent, reducing things like values in order to avoid filing EEI. And if the US PPI does not have records of what they provided and who they provided it to, then they could be exposed to some risk. You also want to get request copies of the authorization provided from the FPPI to the US agent that's doing the filing. You're allowed to request those under the regulations, and the agent is responsible for providing you that authorization proof so that you know that this agent was authorized to file in this case. And it goes towards that auditing thing, lets you know that this person making a filing here is doing so correctly because you maintain all the authorizations and all the filers on that report align with the authorizations that you have on file. Also ensure that the information is being filed accurately and you can evaluate your filer's performance, so on and so forth. Again, exporting is a privilege, not a right. Privileges can be revoked, and you must be able to demonstrate your compliance. Some additional questions here. I'm going to jump back to this before the resources real quick. The best resource for foreign trade regulations understanding is looking at Title 15 of the Code of Federal Regulations. Title 15, Part 30 of the CFR is the universe for foreign trade regulations. Familiarize yourself with that area so that you can make good decisions about how your business is supposed to comply with the export regulations. There are a couple of other links here to Census's AES system, some of their outreach, education, and training. If you're looking to dig deeper, if you're trying to understand routed transactions, Census puts out information. There is an ACE exports data dictionary to help with ACE filing. And then the Bureau of Industry and Security, the BIS, puts out an export management and compliance program publication that is useful for developing a good program internally. And then some of our recent resources on CTPAT trade compliance, sanctions, and anti-boycott, particularly focused on Russia and the war with Ukraine there, and internal compliance programs. The credit code will be provided in the email that goes out that also includes a link to the recording as well as any materials. All that will be provided usually about a week, get the recording edited and sent out. And hopefully you got all of your information and questions answered. I'm going to now circle back to these questions and attempt to answer the remaining questions in the chat here. And now into questions. I'm going to hit the ones on the screen first. We have many different types of export transactions, and I don't know how to begin establishing my compliance program. My advice whenever this sort of question comes up, and this is kind of an amalgamation of many different questions that have come into us over the years, start with finding your role and following the FTR responsibilities. You must ensure that whatever your program eventually does, it has all of the regulatory responsibilities outlined and identified and accounted for in whatever program you end up with. From there, once you've got the regulatory baseline in place, that's going to inform how far afield you go in different scenarios. Most companies tend to have, no more than 3 to 5 different types of transactions. Some will only have one type of export transaction, but 3 is a pretty common number. Some will be routed, some will be non-routed. Some will go to, Latin and Central America. Some will be going to Europe, and they tend to have a pretty consistent framework for them. Or if they don't have a consistent framework, I recommend creating a consistent framework for dealing with certain categories of shipments. Maybe one division sells one particular way and another division sells another particular way. You want to account for those. And really just write down what you're doing, as long as what you're writing down is in congruence with the rules and the regulations that you started with. You'll start to build out your compliance program by observing what's actually happening. Second question on the slide here is, we often sell to companies in the US who will then sell overseas, but we're not involved in the export transactions and we ship domestically. Do we have export obligations? The answer to that question is yes, particularly in the export administration regulations, the international traffic in arms regulations, and with the Office of Foreign Assets and Controls Sanctions and Embargoes programs. Maybe not so much under the foreign trade regulations, which has been the full focus of today's conversation, but there are export control responsibilities that you need to have with re-exports, and you need to be aware of what those responsibilities are and make sure that you're informing your supply chain, including your foreign distributors, including your foreign customers. Hey, these goods may not be re-exported without prior authorization, or under certain conditions, you need to check with us before you can give these goods to anybody else. So, and these export control rules apply to US goods wherever located. They've been exported for the last 10 years, export controls can still apply to those. So knowing what your total scope of responsibilities is a much bigger and deeper conversation. We also had a question from Lakeville, Massachusetts, similar to a scenario that we'd already seen with a client of ours. Is the USPPI allowed to request that filer make changes to the EEI? In a routed transaction, I'm assuming, in a non-routed transaction, absolutely yes. The USPPI should request the filer make changes to the EEI in those standard transactions. In a routed transaction, it can get a little bit messier. The agent here is working for the FPPI, and your obligation as a USPPI in a routed transaction is to provide the agent with complete, accurate information for those 12 data elements. So you don't have an obligation to ensure that what they filed is correct, but if you become aware of it, you need to be able to demonstrate that you lived up to your end of the deal. And if you turn a blind eye, that's going to be viewed poorly. So if you've instead taken steps to notify the filer they made an error of some kind, or that you're aware of a discrepancy in what was filed versus what should have been filed, you have no explicit obligation under the regs to notify them, but you should. And if you don't, you should at least notify Census that there was an error that was made so that they can get accurate filing information on file. Census's obligation is to collect accurate information. So generally speaking, I would advise notifying the filer of the discrepancy, how and why the discrepancy appears to have occurred. Let them take the actions on their end. And if you can request proof that they made the changes, because under the regulations, you're allowed to ask for verification of at least those 12 data elements that you provided. What did they file in line with these 12 data elements? The quantity is different because they split the shipment, that's okay, but you're allowed to ask for what they actually filed for those 12 data elements, and they are obligated to provide it to you. Looking at the questions that are posted here, make sure that I'm not lost. We have our agent file EEI regardless of who picks the forwarder and use FCA Incoterms. Is this considered a routed transaction? My understanding is the transaction is only routed if the FPPI specifically requests to handle the EEI filings. The EEI, the transaction becomes routed only when the FPPI has selected the forwarder and authorized them to be the filer. If the FPPI has not authorized the forwarder, then it is not a routed transaction. You can require your customers to use a designated forwarder of your choosing. That's fine. Then that can still be a routed transaction as long as the FPPI is providing the authorization to that designated forwarder. Just because you're requiring them to use a particular forwarder does not mean that they are not contracting with that forwarder from that point forward. So yes, that can be a routed transaction. The question goes to a person from Indiana. It can be considered a routed transaction only if the FPPI has provided a written authorization to that forwarder, to that agent. Let me read that question again a different way. We have our agent file the EEI regardless of who picks the forwarder. So there's a different forwarder than an agent. The forwarder and the agent in this scenario are different players. Again, the FPPI has to authorize the agent. You can still designate the agent. They can still use their own forwarder, but they have to have provided the authorization to that agent. USPPI, we choose to file the EEI in a routed export transaction with written approval from the FPPI because it gives us the most control and visibility. When the forwarder holds onto several packages and consolidates them into one conveyance, but we have already filed numerous EEIs, is this going against the one rule? How is the USPPI to address this with the forwarder when the forwarder is not working for the USPPI? This is one of the dangers and one of the reasons I actually don't advise USPPIs to be self-filers in routed transactions. The scenario you're describing is allowed. You're allowed to be the filer in a routed transaction if you've got the authorization from the FPPI. You're playing both sides. You're playing both the role of the USPPI and the role of the authorized agent. That's perfectly permissible within the regulations. The reason I don't generally recommend that is for exactly what you described. The forwarder is not working for you, and they can do things. They and the FPPI can do things with the shipment that you never become aware of, and you have the responsibility as the authorized agent to ensure the accuracy of what you're filing. If you're not able to get the degree of cooperation that you need from the forwarder, from the FPPI, wherever else in that communication stream, and it doesn't matter how it happens, but if you have incorrect information on file, then what actually transpired? If goods were exported and there was no accurate EEI on file at the time, as the agent, you're going to be held responsible. The forwarder has no rules under the foreign trade regulations, and the US government is not able to penalize the FPPI. You as the USPPI and you as the authorized agent are doubly responsible for ensuring the accuracy of the information. And a lot of times that's not even possible. That's why I don't recommend that USPPIs act as the agent for routed transactions, because you almost cannot be fully successful. And you're going to have the full scope of responsibility for when something goes wrong. Even though you did everything, you try to do everything correct, it still ends up wrong. That in the export world, I tried hard is not good enough. In the import world, I tried hard is often good enough, but on the export side, it's not. And you need to make sure that you're able to comply with the regulations, not just that you are trying to exercise control to ensure the integrity of the transactions, but at the end of the day, you are actually compliant. And that can be pretty complicated. The answer to your question, how is the USPPI to address this with the forwarder when the forwarder is not working for the USPPI? And the answer is by working hard to communicate with the forwarder and the FPPI that this is what you require in order to do business with us. These are the conditions, these are the requirements. If we are penalized, perhaps we'll try and hold you accountable. I don't know if that will actually hold up in court. Talk to a lawyer about that. But you need to get their participation through communication, through dialogue, through consistency, and through follow through. So what prevails? If the FPPI gives the US authorized agent the POA and controls them, but the USPPI checks the I authorized statement, which one governs the transaction? I've never actually seen this play out in a penalty scenario. My understanding is that the government is going to take a case-by-case view of that event. If they determine that the other circumstances of the shipment align with a routed transaction, then they'll treat it as that in terms of your compliance or your degree of compliance. If they determine that the other factors of the transaction align more closely with a standard or non-routed transaction or less closely aligned with a routed transaction, then they'll treat it as though that was a responsibility. There is no clarity on what prevails if both US and FPPI have authorized the same agent for a particular transaction if they're both involved. When it is a routed transaction, does the agent have any requirements to provide proof of export back to USPPI? The agent is responsible for providing proof of what they filed in connection with those 12 data elements. The agent is not responsible for providing proof of export. The AES record, in fact, is confidential between the filer and the PPI that they're working for, or the FPPI in a routed transaction. Under the foreign trade regulations, the agent is not responsible for providing proof of export. Generally speaking, proof of filing should align with proof of export, but I'm guessing that you need proof of export for things like drawback or some other program or scenario. And the data elements that they provide to you, what they file on EEI, is not going to be the same thing as a proof of export for those purposes. The foreign trade, you can't force the forwarder or the agent to provide you a proof of export under the foreign trade regulations. You can still get them to do it through other means. It's just not a regulatory obligation that they have. Do ACE reports show corrected information to EEI filings? So a problem is found, filer corrects. Will AES and ACE reflect those changes? That's a very good question. I know that for sure that will happen on the import side with the EES 003 reports and EES 003. I like to believe that the corrections will appear in there. I think that they do, but I'm not confident enough to give a definitive answer off the top of my head. Very good question. And I'm going to say I believe so, but the best way to know for sure is to make a correction and then check it. What would you suggest if the agent is not getting back to you regarding the EEI? I know the people at Census love to give forwarders a hard time if they've got a good reason to. If an agent is not cooperating with their responsibilities in the foreign trade regulations, you can contact your U.S. Commercial Services Office. You can contact Census directly. You can contact export assistance networks in your state. There are different ways to get them to put pressure on forwarders to live up to their responsibilities. They know that forwarders or agents tend to be the weakest link in this equation. They know that most U.S. exporters want to comply. They know that most foreign principal parties are willing to comply in order to purchase U.S. goods. And it's a lot of the forwarders in the middle whose businesses are not driven by being compliant. They don't have the same risk profiles and exposure as the seller and the buyer do. And they make their money through volumes and speed. And compliance tends to work in contrast to those things. So if the forwarder is being an obstacle, bring them into authorities. In how severe it is going to depend on which authorities you go to. I recommend contacting your U.S. Commercial Services Office in your state. Certain that your state has a U.S. Commercial Services Office. They're part of the Department of Commerce. They work with the agencies, and they'll be able to get some pressure applied from the government end. Okay, so I think that's all of the things. I kind of went 15 minutes over time. Hopefully I got your question answered. If I did not get your question answered, again, please email us, train@startuc.org. I'd be happy to unpack your scenario. I'm a nerd for these sorts of things. Again, thank you for your time. I'm sorry I went 15 minutes over, but hopefully you all have a wonderful week and are enjoying the nice weather wherever you are. Thank you very much.